So I'm incredibly honored to be on the stage today with two very distinguished panelists. All the way to the left here is Brian Steinwurtzel. He's co-CEO and principal of GFP. He oversees all aspects of the company's new investments, financing, leasing, asset management, development, and project management. They have a concentration in New York City, and they're one of the largest owners and managers there since 1952. Their portfolio contains over 2,500 tenants, 75 buildings, 16 million square feet, and they have iconic assets that everyone may know, like the Flatiron Building, the Film Center Building, 515 Madison, amongst others. Brian received his MBA from Columbia Business School and his Bachelor of Science in Business Administration from Washington University. To my left, immediately here, is David O'Reilly. He's the CEO of a publicly traded company, Hughes Holdings. As the architect and leader of the company's 2019 transformational plan, Mr. O'Reilly has refocused the company on its highly profitable master plan communities. Howard Hughes owns 6.8 million square feet of office, 2.6 million square feet of retail, 6,000 units of multifamily, 36,000 acres of land, master plan communities. They're across the country with concentrations in Nevada, Hawaii, Texas, New York, Arizona, Maryland, and they've got a really interesting entertainment spin-off that we won't go through here today that includes Jean George, some baseball teams, a potential casino in Las Vegas, and then air rights above the Fashion Show Mall. Prior to Howard Hughes, Mr. O'Reilly was the CIO and interim CFO at Parkway Properties, and he was at Banyan Street Capital, and he's also a recovering investment banker like myself. David also received his MBA from Columbia Business School and a Bachelor of Science from Tufts University. So with that background, and then my quick background, I'm the CFO of a publicly traded company as well, Postal Realty Trust, where we manage about 1,900 properties and own as well, all leased to the United States Postal Service. And I as well went to and got my MBA from Columbia University and my Bachelor of Science in Business Administration from the University of Florida. So go Gators. All right. So we wanted to talk about a couple things today up here that I thought would be of interest to the crowd. This will be office focused and then kind of what office can become as well and what's making it successful. And so maybe we'll start with a question to both Brian and David. Look, there's been a lot of press. We saw it in Rebecca's presentation as well about vacant office space. Some people never wanting to come back to the office 5 days a week. I'm curious what you guys are seeing in your portfolio. Is that true? Are you seeing people coming back? Like, what's really going on? And maybe we'll start with David and then move over to Brian.
Sure. I'd say it's very market specific. And within our Houston portfolio, which is the majority of our portfolio from an office perspective, we see most companies back 4.5 days a week. And that's pretty consistent across the board. The office buildings that we own are those that we built in the past 10 years, so they're largely very new, they're largely very well located, highly amenitized and walkable, which is part of what's driving people back to the office. In our portfolio outside of Washington, D.C. and Columbia, it's 3-day a week. Mondays and Fridays are non-existent in the parking lots. So it's market dependent and it's commute dependent and it's location dependent in terms of what the utilization of that office space is.
Yeah, so probably similar thoughts. So from our perspective, we're New York City only. We are the largest landlord to small and medium-sized businesses in New York City. So we see a lot of granular detail around small companies, small and medium-sized businesses. I think that what's happened is a psychological process where if you ask people 2 years ago, they would probably tell you they're never going back to the office, or maybe they might go back to the office. A year ago, they'd say, oh, there's this hybrid thing. I think that we have to come in sometimes. And now what most companies have sort of settled on is that they all want to be in the office at the same time, and they don't want to be in the office at the same time. So what you said is right. Mondays, not so much. Tuesday, Wednesday, Thursday for sure. And Friday is mostly a ghost town. But it also is bifurcated by the quality of the building and the amount of pay the employee is getting. So what we're seeing is that in what I'll call AA buildings, like investment banking firms, consulting firms, high-end accounting firms, you're seeing office occupancy very high, 70, 80% plus, which probably rivals pre-pandemic. But as you go down the stack, I think you're seeing less and less. In our portfolio, we're somewhere in the 50 to 60% range. And I think that companies are using it as a perk to give to employees, right? So in order to retain them, they're giving them a lot more flexibility in when they can come in to the office.
So with that, I mean, what's been the effect on the offices you own? So there's, lower occupancy, people coming in less than they did pre-pandemic. Have we seen economic effects of that, or has it not had that much of an effect on the stuff that you guys own?
Oh, if they come in 1 day a week or 5 day a week, I get the same rent, right? That doesn't impact the economics. And coming out of the pandemic, we have overall greater vacancy in our portfolio, but we've also added 1.6 million square feet of spec office development coming out of the pandemic. Today, all of those new construction buildings that we've built are 96% leased or higher, because the flight to quality, as was in our last presentation, is entirely real. And if you build the best and you have the newest, it has short commutes, highly amenitized, walkable to great restaurants, shopping in a neighborhood, employers are renting that space as fast as they can as a way to attract the employees back into the office more than a couple of times a week. So having that best-in-class building, which was very, very scary coming out of the ground out of the pandemic, has turned out to be an incredible benefit for us.
I agree 100%. I would add, so best in class and best located are equaling highest rents ever, at least in New York City. Rents that are probably something that we couldn't have anticipated prior to the pandemic. Dollar per square foot numbers at the top end, which are above $200 per square foot per year. Whereas as you go down the path, there's a precipitous fall off and probably an air pocket right below like an A building, where you're probably falling, $50, $60 a square foot. So if you're a double A building, you're $150 a square foot plus. If you're an A building, you're probably $100 a square foot plus. And then right below that, you drop probably $50 a foot into the $60, maybe $70 a foot range and down, depending on the quality and location of the asset.
Those rates that Brian quoted have been a huge benefit for us. We are attracting companies from both coasts, New York, Boston, San Francisco, LA, and they're coming into outside of Houston in the Woodlands, which is one of our communities, or into Summerlin outside of Las Vegas. And they show up and it's like, well, we have the highest rents in Houston. We're like 42 net. And they're like, that's all? We'll take another floor. They're coming from 200 at One Vandy in Midtown, and it seems like a bargain.
So would you guys say that rent is back to pre-pandemic levels?
I'd go back to Brian's point and say it's bifurcated. It's haves and have-nots, and this is no different, and everybody said it before, like the malls out of the GFC, the good buildings are getting higher rents than they ever have. The suburban surface parked middle of nowhere office park is fighting for its survival.
I think that's 100% right. Our buildings that are in Soho or Tribeca probably are at pre-pandemic levels. If you're in the financial district or in the Garment Center around Penn Station, you're struggling to probably even find tenants. So it's a feast or famine, and if you're in famine, it's a real struggle, and you're probably deciding whether you want to give the keys back or not.
So given the initial commentary and then some of what Rebecca talked about right before us, I'm just curious from the audience, just as a show of hands, like who thinks that office rents are going to be higher in 6 months? Not a person.
One. I like that guy.
Don't miss him. I like him.
Oh, there we go. All right. Who thinks they're going to be lower in 6 months? Whose arm is not working? How about values? Let me ask that one. Who thinks office values will be higher in 6 months? And lower? Who thinks they'll be lower in 6 months? All right, so we've got a pretty bearish crowd in office. Maybe we should shift the gears and talk about what's been successful in office.
But I think it's actually really instructive that, like, if you didn't raise your hand for higher or lower, I'm assuming you thought the same. Right? Who thinks the same for rents? Not. Okay, more for the same. I bet if you asked the same crowd last year at this conference if they thought office rents are going to be higher, the same, or lower, I bet they would have said lower. I think that's instructive, and I think that's what we're seeing across our portfolio, is that most tenants don't think it's going any lower. And if you don't think it's going any lower, and you know how you're going to use space, you're probably going to make a decision about leasing. And if you think you're going to be in business for a while, and you don't think it's going lower, you're probably going to take advantage and lease space and do a longer lease. And we're starting to see that.
Absolutely.
Yeah, so we had an interesting discussion, earlier today, David, in particular about dynamics of people and the place at which they work. And historically, folks have traveled to a location where the job is that they wanted. I wanted to hear a little bit more of your thoughts and let the audience benefit from your thoughts about how that dynamic may have shifted now, and it's no longer the concept that everyone's moving all around the country to go to where the job is, or within a municipality even to the area where a job is.
Yeah, I think it's been a complete shift in dynamics in that if you go back to the 1940s, up until 2020, the average growth in labor pool, the number of workers in the country, has grown by 1.5 million jobs. In 2021, that shifted. The economists in 2020 said it's going to go down to about 300,000 or 400,000 because the retirees, the boomers, are going to be leaving at an accelerating pace relative to new workers entering the workforce. Last year, we actually saw a decline. And that trend isn't changing. And if you're the CEO of a business and you're strategically planning for the next 3, 5, 7, 10 years, as we're all supposed to, and you're on a growth trajectory and you say we're going to need to hire 50, 100, 200, 500, depending if you're JP Morgan, a couple thousand people in the next 5 years, you can no longer put the sign up front that says help wanted and everybody will just come to you. We used to throw our spouse, kids, dog in the wood grain wagon and drive to where the jobs were. The pandemic changed that. We've now decided that we want to live a better life. We don't want to chase the jobs. We want to chase quality of life. We want access to outdoors. We want great schools. We want short commutes, wonderful amenities, safety and security. So employees are setting the pace, and companies are now forced to follow those employees. And we see this over and over again of companies maybe not completely leaving New York or San Francisco or LA, but coming up with the satellite office in Nevada, in Texas, in Austin, in Houston, in Phoenix, in Florida, because that's where the well-educated workforce went during the pandemic, and they're not leaving just because you put help wanted sign in the window in an area they left because of higher crime, higher taxes, and instability.
So the power is shifted to the employee versus the employer regarding location.
It is completely different.
So in the context of that, maybe talk a little bit, David, about, you've got a lot of new development across the country that you've completed, that you have in the planning stage, that you're active in. Office seems to have been part of that plan in the master plan communities and other communities along the way. Is it still the case, or are you starting to say we're not building as much office within those new developments?
So we build every product type across our communities to meet the demand that's inherent in our community. If we see a demand, we'll build it. Right now, we just built, like I said, we launched a new office building in Summerlin outside of Nevada, outside of Las Vegas in Nevada, right as the pandemic hit, 300,000 square feet, it's entirely full. We started another building a year ago, we're gonna finish that in 6 months. It's another 200,000 square feet, we're largely pre-leased already. So as soon as we build the building and fill it, we'll build the next one if we see demand and we see rates that justify a risk-adjusted return that's appropriate. In the Woodlands, where we have over 4 million square feet of office space, my largest contiguous vacancy right now is 50,000 square feet. That's frightening. Because when that company raises their hand and says, I'm leaving San Fran and I need 200,000 square feet, I got nothing. So we've always have 2 or 3 in the works on the blueprint and planning stages, ready to start that next one to make sure that we have product available as tenants continue to come into the market.
Sounds like it's an applicable thesis to, most of the room is really, has Florida experiences in Florida, tends to be Florida centric. It sounds like this is applicable to Florida as well, where it's find a location where people already live or want to live, and that's where you want to be picking a new place for development of an office or ownership of an existing office.
Well, I'm not going to encourage anybody in this room to go out and build a spec office tomorrow, right? Like 99% of the time that doesn't work. It's a little bit unique for us because we control small cities. The Woodlands, for example, is 28,000 acres. It's roughly 2 times the size of the island of Manhattan. We have 130,000 residents with an average household income of 150,000, home to 9 Fortune 500 companies, and 60,000 people commute in to work there every day. Of the 28,000 acres, there's 700 acres that are undeveloped. We own all 700. So in any other market in the world, when you build an office building, it usually means 2 or 3 other people are building at the same time, and you guys are just fighting to get there first. And if you're last, you're dead. For us, there is no other building. Like if you want to negotiate for an office lease in the Woodlands, you can either negotiate with Howard or Hughes, you get the same answer. That's different and unique for us, but I do think going to where the jobs are and going is the right thing if you're an office investor. And clearly there has been a massive flight of talented workforce into South Florida, into Central Florida, even into Jacksonville and Tampa. And I think part of that is that those AA buildings there are thriving. I mean, like I was in West Palm not that long ago to see what Related's building. These massive office buildings in a market that has always been very sleepy is now filling up very quickly. I think it's a testament to the quality of life that a state like Florida offers and the attractiveness it is to so many people that want to get out of high taxes, potentially higher crime, and seek quality of life.
In some way, the crisis that's happening within the lending sector for real estate is actually a benefit for office, especially if you're in a place like Florida, where you do have significant demand, significant job creation, and now you're going to limit supply. In our business, it's not that complicated. It's supply and demand. You have too much supply and low demand, you're going to be in big trouble. And if you have a lot of demand and a little bit of supply, your rents are going to go up, and you're probably going to do okay. The challenge in places like Florida is trying to keep the supply so it doesn't grow too quickly, and stifle demand. And these boom and bust cycles are what has really, benefited and killed companies. But having a crisis about getting a mortgage or a loan will probably help keep a cap on supply. And as long as there's still that demand here, I think you'll do really well.
And I really enjoyed the earlier speaker, but they talked about the next 3 to 5 year prognosis in office and industrial multifamily, and what the absorption would be, what the vacancy would be, and how much oversupply there is today. If you go back to the global financial crisis, most economists in Green Street, which is one of the preeminent research firms in real estate, said there was a 15-year oversupply of industrial. They were only off by 13 years. But that's what makes a great investor in real estate, is seeing through the economic data to the underlying trends that are going to drive the market. And folks that were bold to build or buy into a 15-year oversupply crushed it. I don't think that the multifamily oversupply, despite all the new units that are coming in these markets, I don't buy it. I see too many smart people continuing to move to these cities, filling those units, buying homes, record home sales. Those same economists said 8% mortgage rates, you never sell another home again. Oops. Home sales across our communities were up 45% last year. It's a lot.
So where we're seeing a lot of the opportunity is along the same lines. So looking for the high demand, but where there's a crisis of capital, which is really what we're in.
Absolutely.
If your loan is coming due and your lender's not cooperating, you're basically out of luck. There's not another lender that might be there. And the same thing is if your tenant lease is coming up and you don't have enough capital to improve the building, even if you have a great building in a great location, then you're probably in a lot of trouble. And so the real opportunities, at least that we're focusing on, are where there's opportunities of a very high demand environment, but the organization that owns the asset is very poorly capitalized. And ideally, for us at least, their balance sheet is upside down, where the equity is actually out of the money, but they still somehow control the asset, and the lenders are trying to figure out how to just escape from that situation.
So you're hearing a lot of private equity and private equity-like companies starting to raise capital for exactly this opportunity. What everyone thought was going to happen during the GFC, that did to some extent, but not for most, this opportunity of distress. Do you guys see that starting? Is it only be a select few that can actually capitalize on it, or is this something that's worth, being a bigger project for other folks in the room, maybe?
I mean, our experience is 2 years ago, the equity would call us up and ask us what we thought about their asset, what we would pay for it, and if we were interested. And we would give them a price, and they would say, we're crazy, we're off by half. A year ago, the mezz guy called us up and said, hey, what do you think about the same asset? The equity guy knows he's out of the money, he's going to hand us the keys back. What do you think about it? We gave him the same price. And he said, you're crazy, you're off by 50%. And today, the first mortgage is calling us up and saying, all right, we know we're in trouble. These guys want to hand us the keys. We are not prepared to take it back. We don't have the ability to take it back. Where's your pricing? And now we're saying to them that our pricing is either at that same level or even lower, and we're willing to transact, and they are now willing to transact. So it's been 2 years. It's a psychological process that we all go through in any kind of crisis that we've been through. And I think people are finally coming to the realization that these asset prices have been repriced and that there isn't a lot of capital, and that's where these opportunities are really going to be. And that's what we're seeing. And it's the larger the asset, the larger the opportunity, just because there isn't enough capital to be there. But all of a sudden, I can tell you, even in the last 90 days, in the projects that we're looking at, where we were one of 1, 2, 3, 4, 5 groups maybe looking at assets, now there's 20, 30 groups that are all of a sudden showing up with real money behind them. And I think that money is recognized that it's time.
I think that says it all. There's 20 folks looking at massive distress. So all this capital that got raised in the GFC and is getting raised now for the generational buying opportunity, going back to the 80s, don't hold your breath. There's so much capital on the sidelines that I don't think we're going to see those generational buying opportunities you just can't miss. There's just too much competition.
I'll give you an example. There was a deal announced in New York last week. It was an office building that had traded in 2014 for somewhere in the neighborhood of $280 million. And it sold for $160 million. They had 30 bidders that bid over 130. That's 30 qualified groups that had over $130 million going after an asset. But it still sold at almost a 50% discount to what it traded for.
With very low leverage, lots of equity.
Yes.
Right? There's just that much capital.
So I don't think the prices are going down, personally. I mean, barring crisis, there's clearly geopolitical stuff that's going on. But
absolutely, there's going to be opportunities, right? There's great assets, strong cash flow, but as you said, borrowers that don't have the capital to refinance or put in the TI, and those are the deals. Those are the opportunities that'll come up.
So opportunities are there for distress within office and buying it to keep it as office, but maybe let's shift gears to what's been a topic du jour lately, which is let's take office and convert it to something else. Let's make it resi is the most popular kind of thesis out there. And Brian, you're in the middle of what I believe is the largest project in the country right now of doing that at 25 Water Street. And I think I've got some roundabout stats here. If it's going to be roughly 1,300 units, let's call it $800 million plus of total capitalization. And it sounds like you'll have your first TCO somewhere at the beginning of next year. Can you talk about what makes that work? Because I think everyone in the room probably understands that you can't do this to every building, even though everyone thinks it's a great, idea. But what's making this one work?
So we primarily have been office players. If we try to buy residential, in New York City at least, it was you're looking at 3.5%, 4% cap rates, at best 4%, and you're building to a 4.5 yield on cost. So what's happened now is with our development team, and just to give you a little bit of background, our development team does mostly for our own portfolio, but we just finished David Geffen Hall at Lincoln Center. We built the headquarters for the 7th largest company in New York State. So we do things outside of that with a very capable group. So I think for us, when we can mitigate the risks that are associated with these larger projects, we feel comfortable moving forward. And what's happened is these projects are now penciling to 7 yield on cost. So when you can build to a 7, you can raise money. You can raise debt and equity because the debt is going to price their loan at a 12 plus yield on cost. It's very comfortable for most lenders. And the equity is going to believe that even if they can transact and sell it at a 5 cap or a 5 plus cap, they're still making a roughly 200 basis point spread on the transaction. And that's enough to get a really high IRR and a really high multiple on their equity.
So building to a 7 in Manhattan, David, is that your experience in non-Manhattan markets that things will trade at a 7 now?
Man, look, the slides we saw earlier, 40% decline in value, it was like, yeah, no kidding. Let's go back to Business School 101, and 2.5 years ago, the 30-year Treasury, which is the risk-free rate, if you will, was at 2-ish, and today I think it was at 4.4. I'm sure someone will check the phone and call me out, I'm wrong. That's 240 basis points of risk-free benchmark higher. 7 may be a great number for Manhattan because it's going to trade at a 5. We're trying to build much higher than that in terms of yield on cost. Part of it is because we have a zero land basis. So if I'm building a multifamily to an 8 in a 5 cap rate world, of that 300 basis point spread, part of that's mark to market of land, and part of that is developer profit. And where that line is, it moves, it's art, not science. So we're typically looking for a little bit bigger premium than that in our markets, but part of that is our inherent low land basis.
Yeah, I think it comes back to market by market. So in New York, we have a government that doesn't believe in capitalism. So they've created rules which make it really hard to build anything. And when you still have a huge amount of demand, there are a significant amount of people that want to live in New York City. Population in New York City has still been going up. They all need a place to live. And if you can't build anything, that means you have an imbalance of demand and supply. And those are the kinds of markets we like to play in, right? Artificially low supply that's limited and increased demand. So with that environment, you can still build and believe in the growth that will come.
Your project's 421A?
No,
Really?
completely market rate.
Wow.
So and again, one of the greatest benefits, it's sort of an oddball thing. Like if you could pay a politician, which we would never do, but if you could pay a politician to limit the supply, you would, right? It's the greatest thing. And what they did was in New York, and I'm sure your states, wherever you live, have similar programs. There are programs that governments have created to create housing, because housing is one of the most important things we have in the country. In New York, they decided to remove all of the programs. So there is no more housing being built under those programs, which then makes market rate even more expensive.
Absolutely, yeah.
So with such an attractive yield in a major CBD, why isn't everyone doing this, and what's not going to work? Like, what are you looking at when you looked at this project and said, you know what, this building will be viable to change to residential? What are some of the key ingredients you had to see in there to make sure it made sense that others may not really be seeing through? So
there's a huge gap between the time that you have to acquire a building, and even with this asset he's talking about was a 1.1 million square foot office building. If you ever saw a picture of it, it didn't really have many windows. It looked like a jail. It's not the candidate that you thought would be the perfect one for a residential conversion. But what happens is that just makes the price lower, right? And because we know there's not office demand for that kind of product, it just drove the price to a point where it made sense to transact. But what happens in us viewing these kinds of assets is that as long as you think it's an as of right project, and as long as you can get a capital to believe in it, you'll fill this gap from the moment you buy the building until you get your GMP. Right? So for those of us in the development world, most equity and most debt doesn't like to actually fund projects until you have a GMP, right? Because you're at risk up until that moment, and even after that moment, you're a little bit at risk. So for us, if we can fill that gap with our expertise, with our equity believing in us, and our lenders believing in us, then we probably have an advantage and then can drive the price even lower.
Was there certain things inside the building, though, that you looked at to say this can convert, or can this be done to every office building?
I mean, honestly, the larger the asset and the more difficult it is, equates to the lower price. And the lower price equates to the bigger opportunity and the bigger spread for us at the end of the day. So the easier the project and the more likely it is, the more competition we would have. So this asset has a team from just our company that's 12 people on site. Our general contractor has 35 people on site. Yesterday, we hit 420 workers on site. We'll max out around 650 workers on site. There aren't that many organizations that can handle that kind of project in one location. So, when you sort of balance out the risk associated with it, the price, sort of is so low that we have a lot of room for error. And the good news is we are, at this point, knock on wood, 3 months ahead of schedule. We're within 1%, we're fully bought out, GMP signed, and we have $30 million of unallocated contingency. So we are well on our way, and for an asset that we acquired in December last year, not 23, but 22, we should open in January 25, so in roughly 10 months.
That's incredible. Can't get a permit in 10 months in New York.
It's very difficult, but New York, it depends on which market you're in. If you're in a market that has as of right zoning, it mitigates a lot of these risks and issues. New York happens to be that market. If you're in a market where you have to get approval from a local land use committee or some architectural committee or something else, then the speed to market will be much more difficult. The requirement for a contingent contract will be much more important, and the price that you're going to have to pay will really vary.
So is this going to work outside of Manhattan on smaller scale, in the markets you're in, or is this like got to have a big building, got to do it in scale, have to do it in CBD?
Look, I don't want to speak for all assets. Across our portfolio, there are some assets within our communities that we don't own. They're older B assets that were built and sold 20, 30 years ago. We've looked at them and tried to retrofit them. What we've seen, and these are more suburban locations, different than New York, is that the larger floor plates of office creates an apartment layout so that it feels like each apartment is like a bowling alley, like long, linear, narrow to get to a window, unless you have a massive core. And it's just hard to make the math work when your alternative on a 2-story surface parked office building on 4 or 5 acres is just scrape it and densify it in a massive new multifamily project. That makes much more economic sense in that setting where there's less land constraints than lower Manhattan, which is probably the second hottest renter market in the entire island of Manhattan. It's just a perfect location for a conversion.
If you happen to be looking at one and you see the distressed office building and you think that maybe it's right for conversion, I think the number one issue that we see is, how do you deal with the center of the building, right? Because clearly by the windows, you'll get great light and air and it'll be fine. My advice to you would be just to imagine you put up a wall in the center and you just forget about it. And you just assume it's not even there. And then price the building that way. And if it prices that way, then you can go forward. And if your local zoning community will let you somehow reallocate the FAR, or if it's in a suburban community, you can build on the parking lot and you can use that as a phase 2 or something along those lines. Maybe you have opportunity to do it. But that's the way we look at these buildings. If we can't figure out a very high demand product, then it's just not there. Don't even factor it in and see if your project still works without it. And if it does it, then you're golden, because if you figure out how to use it in the future, it's even better. It's just icing on the cake.
So before I continue, I don't know if we have a microphone floating anywhere, but I think everyone here is happy to take some questions if anybody in the audience wants to ask anything.
First, I want to thank you guys for your time. That was a really interesting and informative conversation, but this is more in specific to David. You discussed how COVID has had an effect on attitude towards work in terms of people being less willing to travel and more prioritizing quality of life. I'm curious, do you think this also can be attributed to kind of a generational shift towards work? I know, as a Gen Zer, I feel like our whole generation is just having such a different attitude towards work compared to, Gen Xers and Boomers. I hear a lot of Boomers saying, I got out of college and I swept the floors and I was paid pennies and I was willing to do that. And maybe now I'm not speaking for, my whole generation, but for myself, I know that I'm not willing to do that, in compromise of quality of life. So obviously, I just want to see, do you think that generational shift will also have an effect on office as an asset?
You just put like a big bear trap down for me to step on and like poo-poo all over the millennial generation is not working hard. Not going to go there. I do think there's a generational shift in terms of priorities. That's not to say that this generation doesn't work as hard. They're not as committed to their job. They don't care as much about where they go to work every day. I think they care more. They care more that the company they're working for is doing good than the generation before them. And that priority shift is really important. And I think as a CEO of a company, as a leader, having purpose for the people that you work for is the best motivator, more than the almighty dollar might have been 20, 30 years ago. That shift has led to the acceleration of the shift in demographics that was started before the pandemic, but caught fire during and after. And people traded almighty dollar for quality of life and time with family. And I think that was across generations. So there is some generational nuance in terms of motivation and rationale for why we come to the office, why we choose to work for the companies we do. I don't think it's a shift in how hard people work or how much they want to be in the office. All the boomers are pissed at me right now.
So I want to dive into what I'll call the trophy or triage comments that you made earlier. And I wanted to raise my hand every time when you were asking on are rents going to go up or down. Because I guess I would, as a non-office guy, see rents and trophy continuing to go up and rents and everything else continuing to go down. Do you see that divergence in rents and that divergence in values increasing, decreasing, or staying the same? Show of hand, no.
I agree with everything that you said. The haves will see rent growth, the have-nots will go to zero. The value decline in the have-nots will be substantially greater than the value decline in the haves, because even though the haves are getting better rents, all-time high record rents, low vacancy, strong cash flow, their values are still coming down. Because if you think about cap rate, it's a proxy for weighted average cost of capital. And if you're a lender, rates are higher because the treasury's higher. If you're an equity investor, the return requirements are higher because there's greater risk in office and we price in risk every day and it's coming off of a higher benchmark. So if cap rates truly are a proxy for weighted average cost of capital, they're going up, and even though your cash flows are higher, your rents are higher, your operating expenses are absolutely higher, your insurance, utilities, and real estate taxes have probably doubled. Your free cash flow, maybe in a really good case scenario, is flat. With a higher cap rate means lower value.
So I had a question. You had talked about buying these huge buildings and converting to multifamily, and I get that you can buy them cheaper per pound, but I've looked at it, and a newer building that maybe have 10 to 20,000 square foot floor plates can make sense. I've done some conversions as well as finance some. But if you have a 40, 50,000 square foot or bigger floor plate, how do you make that work? I mean, you said maybe you take this middle of the building and do something else with it, put a bowling alley. I don't know, but can you really make that work with those big floor plates?
Yes. So I think that at scale, you can do a lot more because you just have a lot more area to spread the costs over. So the transaction that Rob was mentioning that I was talking about earlier, that floor plate was roughly 50,000 square feet. The two basements, which one of them has ceilings almost as high as this, is a football field long. So what we did, how do you do it, right? So in that one, we actually carved two very large light wells out of it. So basically created two donuts out of the building. The light wells, to give you a sense, and sorry, I live in New York, but if you took like the this townhouse on Fifth Avenue, something that a Vanderbilt would have lived in, and you pick it up and you turn it on your side, you could drop it into the light wells and have room all around it. So these are enormous light wells. And what ends up happening is because we can place them wherever we want, the units that are around it, even though they're only looking into a light well, they don't have great views, they're the most efficient ones that we're building. So in New York City, a studio can get to roughly 350 square feet. That's probably the tightest you can make it, still have a bathroom, a kitchen, and have like a legal living area. But that studio on a price per month will be the least expensive, as you might expect, in a quality building. But on a per square foot basis, we will get over $110 a foot for that studio. And that will be the best price per square foot we'll have anywhere in that asset, even compared to the units on the top that have the best views. And the area that we removed, the 2 sections, we're able to build another 10 stories on top of the building. And that, even though it won't get the same price per square foot as a 350 square foot studio, they will get the highest rents for their line in the building. But we can do that because it's such a large asset. If you're doing it for a 100,000 square foot building, it probably doesn't make sense, because the most expensive part of our project isn't cutting a light well out, or in that building even removing the facade and putting a new window wall. It's time. The interest payment that we're making is $350,000 a day. So every day is by far more expensive than anything else that we're doing in that project. And so speed to completion, but at scale, allows us to do these really hyper creative things. But we have another office residential conversion, which is a little less than half the size. And in that one, the floor plate's more like, let's say, biggest is maybe 25,000 square feet, all the way up to 5,000 square feet. And that one, like I said earlier, we're just ignoring the space in the middle. If people want to rent it for storage, if somehow zoning changes and we can do something else with it, or sell the air rights to the neighboring building, we'll do something later. But I think you have to be super creative about it. And, a lot of them we just pass on. If the price is too high, it doesn't make sense to make that margin, just move on. Or wait. Like I said, 2 years ago, tons of calls. All those calls are coming back. And I'll finish this up. The asset that we are doing the 1,300 units, we looked at it 3 times before we bought it. And the one that we're doing now, which is, like I said, a little less than half the size, we looked at 3 times as well. So,
amazing. So I think we have time for one more question, if there's one from the field here. Looks like in the back there.
Hi. I'm Teresa Callan. I'm an investor, but I live in Gainesville, which isn't the sexiest market in Florida, but I like to say that we're a sure thing, right? So high cap rates, we're expanding. We've got a lot of growth on the periphery of the university where, everybody's hot for multifamily, and I get these calls all the time. So, but what we're not addressing right now in some of the smaller markets, third-tier markets like Gainesville, is that we can't do conversions like you can in Manhattan from office to multifamily. However, we can do other conversions. And I think, for example, we don't have enough last mile distribution. We don't have enough fulfillment space. What are your thoughts on utilizing some of what we have in store in office parks that are sort of on the outskirts in the suburbs and converting them to that use?
I think that those suburban markets, those office parks that are out there, often the floor plates and the ceiling heights don't transfer well to other uses, logistics or other, maybe self-storage. Given that they have larger land underneath them and they're typically surface parked, scraping the buildings and actually building what fits is usually the highest and best use. Like the land value underneath some of those office buildings is worth more than the actual buildings themselves. And that's how I think a lot of these trade, providing there's a clear roadmap to changing zoning.
So I don't have an answer for your specific problem, but in my experience, like, real estate's local, and I found, maybe contrary to what you guys see, but I found that most politicians really want to help. And I found that when you have a project where it doesn't quite make sense, but there is some demand, it sounds like you're talking about there is some demand for this product, but somehow the supply isn't there, or the cost basis isn't there, I would work with government to try to figure out how to create incentives to do it. And if you really have a demand, there's people that will want to use it and that will pay something that's substantial for it. You'll figure out through some sort of a rezoning or incentive process that you can create something out of it. But the key is the demand. Like, there's not enough demand, I wouldn't bother. But if you have that demand, I think you can be creative, and I would go to the local politicians and try to figure out a way to do it. I mean, we did that with artist studios in Jersey City, and we have it in Long Island City, just right next to New York. We knew there was a huge demand for artists that just wanted a basic area to paint and do whatever they're doing, and we figured out a tax structure that made sense for the government to provide incentive for them to do it, and it worked. But you need cooperation.
I couldn't agree more. We're working with the governor of Nevada right now in Sony Pictures to get a film studio tax credit bill passed that would generate $105 million of tax credits for people that film movies in the state of Nevada, specifically within the studios we're going to build in Summerlin with Sony. And there's a huge demand to film outside of Hollywood, and it's driven by tax credits, and it would diversify and strengthen the local economy. So the governor, state legislature is largely behind the bill, and they see the benefits, and it's the same thing. There's demand there. The economics just don't make sense unless there's a little bit of kick in from local government.
Great. Well, I think we're at the end of our time slot. I know both Brian and David will be around for a little bit if anyone has questions they want to grab them on the side afterwards. But thank you so much for traveling down here and participating.